Hey guys, it's Jamin Kirkwood with Secure Financial Management. I just want to get out a quick video. I think it was going to be my last video of the year. And I want to get a quick video out to you about something that's been going on in the financial markets recently. And you know I like to get out information to you and share anything that we come across when we're looking at our investment strategies and portfolio management. And it's an important topic, which is the reason that even this close to Christmas I want to get a message out to you. And it's about something that happened in the markets last week. And it's a phenomenon called an inverted yield curve. And any of you that have been to kind of any workshops that I've done, or even if you've just watched some of these videos, you've heard me talk about an inverted yield curve before. It's one of the factors that we look at in making our investment decisions. I'm always talking to you about stick to the facts, stick to the things that we can measure and make investment decisions from that. Well, now we've got one, right? Because we actually got into an inverted yield curve situation last week. And you know, it's not as though we have enough going on in the markets now already, right? With the Fed raising interest rates, the whole issue going on with China, Brexit drama in the UK with Europe. Now we add on top of that an inverted yield curve situation. And to take a step back, let's talk about what an inverted yield curve actually is, okay? Typically, the yield or the interest rate that is paid on bonds increases, the interest rate is higher, the longer the duration of that bond. And we say duration, it just means time frame, right? So there's bonds that the Treasury issues. They go from, there's a bunch of them, but 3 months, 2 years, 5 years, 10 years, 30 years, and some in between. But in a traditional interest rate environment, what you'll find is that the longer that duration of the bond, the higher the interest rate that it's being paid. So obviously a 10-year would be paying more than a 3-month in a regular environment. A 5-year would be paying more than a 2-year, and so on. Pretty simple sort of concept. When we get an inverted yield curve, that's not the case. What we're finding is that on a shorter duration bond, in this case a 2 or a 3-year, the interest rate is higher than a 5-year. That's pretty weird, right? Why would you be getting a higher interest rate, a higher yield, for tying your money up for shorter? It's an unusual situation. It doesn't happen very often. When it does, it's typically a harbinger of not so good at economic situations coming in the future, okay? So I want to caveat this with a few things, all right? The typical inverted yield curve that we look at from an economic and investing point of view is the 3-month being higher than the 10-year, right? There's obviously a big duration spread there, but when the 3-month Treasury bill is higher than a 10-year note, that is typically what we look at as an inverted yield curve. The yield curve that inverted recently was a 2 or a 3-year. Both of them were higher than the 5-year. Not a good sign, but it's not the typical metric that we look at for an inverted yield curve. If the 2 and 3-year are higher than the 5, it's quite possible that in the future that 3-month will get higher than the 10-year. So it's something that we're watching very carefully. But you've probably heard stuff about the inverted yield curve in the press, so I wanted to get an explanation video out to you guys about it. So it's not exactly the yield curve that we typically look at, but not really a positive sign. It's something that we're watching very closely. The second point I want to get out to you is that when the yield curve inverts, the markets and the economy don't fall off a cliff the next day, right? Things have been tough. It's been a very tough year to manage money, especially the last 6 to 8 weeks or so have been particularly difficult. So in general, the market hasn't been great. But the yield curve inverting doesn't put the economy into a recession the next day. Actually, typically, after the yield curve inverts, it's 12 to 18 months after that the economy will go into a recession. Typically, the markets still peak 12 to 18 months after that yield curve inverts. Then we have some economic downturn, right? So it's not something you have to take action on immediately, but it should certainly get your attention and warrant more active money management when we see the yield curve invert. So I just wanted to get some information out to you guys. I also want to take a moment to wish you a Merry Christmas and a Happy New Year. As always, this should not be taken as investment advice. If you have any questions about your portfolio, what's happening in the economy, please give us a call at the office here, 210-428-6250. We'd be happy to speak with you.